This conference will now be recorded.
Okay, guys, thank you very much for joining in. We are going to be starting out with a session called What Exactly is Corporate Bond? Okay, this is from a series of Foundation of Finance that we are talking about, where we're going to be talking about few details which are not there in your curriculum, but this will help you to understand the concept in a better way. Okay, so with this, we're going to be starting out with the topic. First, what exactly is a bond? Okay, now a company or an organization or an institute need money, okay, to raise they need money to run their operations. Okay, now whenever they're running this business, okay, or where they need people to be a part of this organization, or they are producing a service or a good, they need money to sustain. Okay, so companies which are basically, say, Hindustan Unilever, Tata, ITC, Reliance, they come up with IPO. Okay, now when they come up with IPO, they are giving out shares of their company, that means ownership of their company, okay, so that it can be passed on to the others. Okay, now that is equity. Apart from equity, you also can raise money from the market through fixed income security. That is nothing but your primarily bond market. Okay, so bonds are issued by large organizations. They are also issued by government bodies. Okay, for example, in Bombay you can see BMC issuing bond, Maharashtra government issuing bond, Andhra government issuing bond. Okay, a city can also issue a bond because they need money for their own individual projects. Okay, they need money only for their specific need of the project. Okay, now whenever they need money, they can either go to a bank or they can go to a market. So bond, when they're going to the market, when they're going to normal public, through a medium of bond, they can raise money, and hence the bond are generally called as fixed income instrument. Bonds are generally called as fixed income instrument. Okay, generally, why fixed income instrument? When the bonds were initially started, they were started because they were giving a fixed interest as compared to equity. When we talk about equity, it means shares. Okay, so this is a brief introduction about bonds. Okay, I'll quickly take a pause. Can you guys please confirm if you are able to see me properly? If you are able to see me properly, can you guys please confirm?
Yes, I can.
Okay, and whenever we're going to be conversing, please put the detail on the chat window so that we can discuss properly. Okay, perfect. Now moving towards the next section. Okay, so basically companies, okay, or any organization who is a bond issuer, okay, they need money, they need capital, so they will go to the investor. Okay, investor will invest in a bond, that means he is providing capital, okay, to the bond issuer. Okay, and then the bond issuer will ideally promise, okay, to pay interest on some particular dates, on some fixed date. Okay, that interest is called as coupon. Please be very careful, that interest is called as coupon. Okay, now the interest payment is being made to the bond investor on a periodic time, and finally the principal amount, that means the capital amount which was initially given by the investor, is also paid out to the investors at the end of the contract. Okay, so it's basically a loan which is given out. It is basically a loan which is given out to the bond issuing company or the organization or the government, okay, by the investor, and for that the investor is getting some fixed amount of money. Okay, the investor is getting some fixed amount of money. Okay, this is a brief introduction about bonds. Now let me give you examples about bond. How does a bond actually looks like? Suppose there is a bond, okay, which is available in the market, which has a price of $8,500. That means if you're paying $8,500, you will become the owner of the bond. Okay, and this $8,500 will be given to the seller of the bond. Okay, Now, suppose there is a bond available which is available for 6 years, and it pays semi-annually. When we talk about semi-annually, it means after every 6 months. And how much it is going to pay? 8%. Now be very careful over here. When we talk about 8%, okay, you have to be competent about what is the principal amount. That is basically the face value, or basically the $10,000 principal amount. Okay. Now this 8% is going to be calculated on the $10,000. So 8% of $10,000 is primarily your $800, but this $800 will be paid semi-annually. That means every 6 months. That means 4%. Hence, when you look at this diagram, every 6 months you're getting 400, and finally in the last date you're getting the principal plus the coupon. This is principal plus the coupon. In case of any confusion, you can put out your query on the chat window, or else we'll be also opening up for questions in the end. Okay, so this is a basic structure of a semi-annual bond, where every 6 months you're getting the coupon or the interest, and finally in the last you will get the principal amount plus the coupon. Now come to the second example. Now this is an example of an annual coupon. Okay, suppose the bond is taking a principal of $1,000. The current price of the bond is $850. Okay, and it is a bond of 6 years, but it is paying you 4% annually. Now this 4%, okay, is primarily given every year because it's an annual bond. You guys see this? These all are coupon, and this is your finally principal plus coupon. Okay, so these are the examples of bond that you generally see in the market. Now in your FRM exam, okay, the focus would be on what exactly is bond, how the valuation of bond is actually done. Okay, we'll be moving towards that part, but when we talk about this section in today's session, we are going to be primarily focusing on what exactly is a bond and some different aspects about it. So we are not going to enter into the bond valuation piece today, right? So what are different types of bond do you see in the market? The first is a government bond. When we talk about government bond, we are focusing on the central government. This bond is also called as sovereign bond. That means government of India issuing bond, okay, to raise money for its own projects. Okay, they want to create a highway, they want to create a power plant, they want to create a wind plant. So those kind of projects need money, and that is generally given by issuing by the bond. So these bonds are also called as GSEC, government security, or also called as treasury instrument. Okay, these are government bonds. Then also you will find municipality bonds. When we talk about municipality bond, our focus is primarily on, say, BMC, which is in Bombay, issuing a bond because they want to lay out roads. For example, they want to start out with some small projects, some water treatment plant, anything which is of their interest. So they need money, so they can issue a bond also. That is primarily your municipality bond. There are other section which is basically corporate bond, which is our focus for today. Okay, so big companies can also issue bonds, okay, for their own individual projects. So we'll now quickly look at some of the details. So the first part is about the government bond. Now government bond is more secure. Okay, they are also called as treasury instrument. So there can be treasury bonds, there can be treasury bills, and there can be treasury notes. We're going to be talking about these things in detail in after a few slides. But the idea is that wherever a government is issuing a bond, they're called as treasury. That has to be very clear. Now, one more thing that you have to identify is that these security, the government bonds, are very secure. When I'm saying secure, that means there is no risk for you, because the government is giving you a backing that if you need money, okay, I will give you back your money whenever you need, basically. So there is a guarantee given by the government. Okay, that is the first part. That is why you find very less risk. Okay, very less risk in this instrument. Next is municipality bond. They are also a government entity given bond, but they are little bit more riskier as compared to the government bond. So there have been instances where municipalities have defaulted. When I'm saying defaulted, that means they are not in a position to pay you money back. But government of India has never defaulted. Okay, so municipality bonds are also issued by the government entities, but they are a bit riskier as compared to the government bonds. Okay, apart from these two, there are also other government bodies. For example, LIC, State Bank of India, Hindustan Petroleum, they are all entirely government owned companies. They can also issue bonds. Okay, now our focus for this chapter, which is basically a corporate bond. Okay, now whenever a government is issuing bond, their income is the taxes which they are putting on the citizens of this country. Okay, but for corporate, they need to generate cash flow. Okay, they need to generate cash flow so that they become very credit worthy. When I'm saying credit worthy means जिसको हम पैसा दे सकते हैं. Okay, so obviously the companies will look, the investor will look at the credit rating of the corporate bond. Okay, when I'm saying credit rating, this rating is given by a third party called as credit rating agencies. Okay, they look at the company, and based on the riskiness of the company, they will give a rating. Based on the riskiness of the company, they will give rating. Okay, so that is primarily being given or allowed. Okay, now corporate bonds are obviously risky because there have been instances where companies have defaulted on the amount that they have taken from the investors. So obviously it has the highest amount of risk, and bonds which are having the highest amount of risk are also called as junk bonds. So in a nutshell, there are three broader categories where you can divide the bonds in terms of the issuer. The first is government, second is your corporate bond, and third is your municipal bond. Okay, now when we look at our focus for this session is primarily on corporate bond. Whenever you wish to issue a bond, suppose if I am a company and I want to issue a bond, I will first go to a trustee. Now trustee can be a bank, it can be a financial institution. Okay, so generally it's a financial institution which acts as a trustee. Okay, so if I am an issuer, can you guys see the diagram at the bottom of the page? The issuer, okay, the issuer will go towards a trustee, okay, and will say, okay, I need to issue bond, please help me. Okay, now what is trustee going to do is trustee is going to help the issuer in raising out a indenture. Okay, bond indenture. This term is very, very important. You can see it over here also. Bond indenture. Bond indenture is nothing but a document which tells you what all responsibility is of the bond issuer when he's taking money, what all rights are available with the bond investor because he's investing money. Okay, this bond indenture is also called as trust deed or a trust indenture. The name is also been mentioned over here, the trust deed or trust indenture. Okay, now if you want to issue a bond in the, so now primarily we are focusing on the US market. Okay, in India also the rules are more or less similar. In US market, if you want to issue a bond, you will have to go to a trustee if your bond amount is above $5 million. If your bond amount is above $5 million, then you'll have to go to a trustee. Trustee will help you to form the indenture. Okay, now trustee is there between the bond holder and the bond issuer, because if tomorrow the bond issuer, who is suppose a big organization, a big company, is not in a position to pay back the bond amount, then the bond trustee will take care of all the legal requirements, going to the court, going to the regulator, filing, everything will be taken care by the trustee. Bond holders need not worry. Okay, so in the recent past, you must have seen about IL&FS. IL&FS defaulted on its bond. Okay, they had taken money from people, but they were not able to pay back money because of some of their internal problems. So bond trustee, whoever was there in between, will basically go to the court, will file a case against the bond issuer because they have failed to follow the bond indenture, what was written in that document. Okay, so I hope this slide is clear. In case of any confusion, you can put it on chat. What I would expect you guys to do is to read the content properly on the slide and just confirm back to me on chat, are we good to go? Perfect. Thank you for the confirmation. Now moving towards the next part of the same discussion. Okay. Now in the indenture, everything will be detailed out. Okay. For example, they will talk about what is the interest rate, what is the coupon that is going to be given to the bond holder, what is the date of maturity. So in my previous example, we talked about 6 years, right? So every different bond will have different maturity. Someone will have 10 years, someone will have 15 years. So that date of maturity will also be specified. The procedure, okay, how can you make a change to the indenture, that is also will be mentioned. Suppose if the company is not able to pay the money back, then you will have to go and change the indenture. Suppose you are saying, okay, give me money after 2 years. If you are a bond holder and you're saying give me money after 2 years, so you'll have to go and change the bond indenture. So you'll have to define how that change can be done. Do you need everybody's approval? Do you need 80% of the bondholders approval? Do we need 70% of the bondholders approval for the change? That has to be defined in the indenture. Okay. One very important part which is also mentioned in the bond indenture is that what is the purpose of the bond issue. So if tomorrow Reliance Group is planning to enter into telecom sector and planning to start out with Jio, okay, and they need 50,000 crore rupees and they're coming up with a bond issue. Okay, now they will have to mention in that bond issue that this money is going to be invested in the telecom sector and we are going to be doing these projects. Okay, because the investors money is getting invested, they should be aware about where exactly their money is getting into. Okay, further, the name and the contact information of the trustee should also be mentioned in the bond indenture. Okay, further, when the coupon payments are going to happen, is it going to happen on 1st of January, is it going to happen on 1st of February, is it going to happen on 1st of June, which date the coupon payment is going to be paid is also has to be decided in the bond indenture. So we have right now talked about one important document from the bond, which is bond indenture. What is the role of a trustee? Okay, now I'm taking you towards how exactly the bond is issued in real life in the market, how exactly the bond is issued in the real life. Yeah, I think so. There was some network issue. I'll repeat the entire sentence again. So the first important step is basically approach to the operation. Okay. Now, when we talk about approach to operation, it basically means the company or the bond issuer is trying to identify what is the need of financing. That means, suppose if I am Adani Group and I see an important project coming up in Australia, which my company is undertaking. Suppose that project is nothing but a power plant. Okay, so I will need money for that. So first will company identify how much amount of money is required, how much amount of money is available with us, and how much amount of money we can take from the market. That is the first step. Okay, sorry, first step. Kindly go through the first step. Okay, the moment they identify the amount of money required, they will go to a investment bank. Okay, because investment bank is going to help the company to raise money from the market, because they are an expert in raising money from the market. So you'll go to either JP Morgan or say for example Kotak Mahindra Investment Banking, HDFC Investment Banking side, SBI Capital Markets. So these investment banks help company to raise money from the market. Okay, very simple. The first step. Okay, now this investment bank will basically guide and will give a confirmation. Okay, this is the amount of money you can raise from the market based on the company's profile, based on the project's profile. Okay, now the investment bank will help the company to go to the rating agency, like I mentioned before. Now rating agency like S&P, CRISIL, ICRA, Moody's, okay, Fitch, these companies are rating agencies which are operating in India and abroad. Now these companies, what do? Is they look at a proposal, and based on the riskiness of the proposal, they will rate you. Okay, so if your rating is highest, which is triple A, triple A, that means you are very low risk. That is why you're getting high rating. If your rating is very bad, that means you have a very high risk in your issue. Okay, so rating agency is basically involved, and what they do is they look at the entire project and look at the entire bond issue. Okay, suppose Adani Group realize that they need 50,000 crore, so they will decide, okay, we want to raise 50,000 crore. They will come up with the document, bond, indenture, with the help of the investment bank, and they will take it to the rating agency based on all the documents, based on the sectoral analysis, based on the market, everything. They will decide what exactly is the rating for this bond issue. What exactly is the rating for this bond issue? Okay. Now suppose the rating company issued a bond of single A. So the highest is triple A, then you have double A, then you have single A. Suppose that company is given a rating of single A. Now this rating will help the investor who has the money to decide whether to invest in this bond or not. Okay, so basically rating agencies are helping bond investor to identify where to put their money. Okay, kindly read the second part. Kindly read the second part. Okay, so moving ahead now to the third step. So once we have went to the rating agency has given us a document. Now we'll go towards other legal formalities. Okay, some legal documentation that has to be prepared. Okay, which will go to the banks, which will go to the regulator. So in India, if you want to raise money from the market, you have to go to SEBI, which is Security Exchange Board of India. Similarly, if you want to raise money from US market, you have to go to SEC, Securities and Exchange Commission. Okay, now whenever you go to the regulator and you're requesting for the bond issue, they will ask you so many documentation, they will ask you for some fees. So all of this entire thing, okay, the legal documentation, talking to the rating agencies, this will happen through preliminary meetings. Now this entire thing is been covered over here. There are also lawyers involved in between. Suppose if the amount is so big, there can be litigation related issue. You need people who will write down the legal document in a proper way. So you will also hire a lawyer or a law firm to help you in this entire process. So kindly read this entire bullet point, 2 bullet point. This is a third step that happens in the real market. Are we good till here? Kindly confirm on chat. Are we good till here? Perfect. Now moving towards the third and very important, sorry, fourth and very important step. Now whenever you are issuing a bond, you are actually issuing it in the primary market. What is a primary market? The company is directly selling the instrument to the investor. Okay, now suppose if I am the investor, I am the bondholder. Once I purchased it from the company, from the primary market, if I want to sell it to somebody else, okay, I can go and sell it to the next investor. That is basically in the secondary market. So whenever you purchase something in primary market, you need a secondary market so that you can sell it off to somebody else, and somebody else becomes the owner of that bond. Okay, that happens in the secondary market. So the exchange that you see, the exchange, NSE, BSE, these all are secondary market, because IPO happened for a stock. IPO happened, that was the primary market, and once you have got the shares, you are selling it in the secondary market. Similarly for a bond, when you are purchasing a bond from the issuer, that's primary market. Okay, but when you are issuing, when the issuer is doing this activity of issuing a bond, the first and foremost thing that he will do is he will conduct a road show. Okay, now what does a road show means is that you are actually talking to the investors, big investors. This can be mutual fund, this can be insurance companies, big banks, or big other corporates. Okay, so you will say, organize a meeting for all of these guys, which is called as road show. This is the industry terminology, where you will give a presentation about the bond issue, you will answer their queries, and you will actually open up the book and you will start taking the order. That means some of the companies might be interested in purchasing a huge quantity of the bond directly from the company. Okay, so they will ideally go and present their interest in purchasing the bond. Okay, so basically the road show is a meeting between the prospective investor so that they can directly invest in the bond instrument. Okay, so that is the basic purpose. It also needed because if there is any question from the investor side, okay, that questions can be addressed with respect to interest, with respect to maturity, how the money is going to get used, all of that stuff. Okay, so kindly read this road show piece. Okay, and based on the interest of the consumer or based on the interest of the investor, we can decide the price of the bond. Okay, kindly read this entire paragraph. This will give you an idea about how exactly companies do roadshow. Okay, so you might go to different locations. Okay, conduct meetings with. So if you want to issue bond globally, then obviously you will go to Paris. You will also go to US, New York primarily. You will also go to London and meet up a lot of investors and try to sell your bond. So you'll conduct meetings over there. Okay, this is a very important step because this helps you to understand what is the interest in the market. Okay, then what you will do is primarily you will open up the bond. Okay, you'll give a window of opportunity. Okay, for the market. Once you have got the interest idea, then you'll open up the book. When you open up the book, which basically means you're taking orders, you're actually taking order from the companies, from the big corporates, from the banks, how much bond they need. That is basically the window of opportunity that they're getting, okay, to establish, okay, and to pay, to purchase or to basically show their interest for that bond. Okay, that is also called as book building. You would have heard this term that book building is happening. That means we are actually taking orders from the market, from the investors, how much bond they need. So kindly read the first two paragraphs. I've talked about the first two paragraphs. Okay, now when we talk about book, it is actually a digital book. It's basically a digital ledger in which you will actually make entries. Okay, suppose Tata Group wants 1 lakh share, 1 lakh bonds. Okay, there is other company, ITC wants only 50,000 shares. There is LIC which wants 10 lakh shares, 10 lakh bonds. Okay, so you will actually take up all the entire list of people who are companies who are interested. Okay, that will become part of the digital ledger. Okay, and also once you realize, okay, these many people, suppose if you wanted to issue 1 crore bonds or 1 crore bonds, so out of that 90 lakh has already been taken by the investors. Then you have rest 10 lakhs which can go to the retail investors, like retail investor like me and you, individual people who have the ability to purchase bond. Okay, so that will be opened in the market on the day of the issue primarily, where you can actually apply and take the bond. So on that day you actually see a lot of calls being done. So based on the demand from the retail investors, you can change up the price based on if it is very what do you say, if it is very huge demand, then obviously you can increase the price of the bond so that you can take extra money or you can raise extra money from the market. Okay, that is basically been done in the third part of the paragraph. In case of any confusion, put your discussion on the chat window, and we'll address the query. Okay, so post the roadshow, the bond is placed in the market, and once everybody's interest is received, we will do a final allocation. That means who is getting how much amount of bond. Okay, so like Reliance wanted 1 lakh shares, 1 lakh bond, but we can issue only 80,000 bonds to them, then that is fine. We'll make a note, okay, 80,000 bond has been given to Reliance at this price. Okay, so that is where your allocation is happening, and you're actually deciding the price on which you will be giving out bond to everyone. That has been covered over here. Next, suppose I am Reliance and I have already purchased a bond for a company from some other company, and I want to sell it out now. After some time, if you realize that I do not want to hold this bond further, I want to sell it out, this bond, then this bond can be sold in the secondary market, like I mentioned, where the dealing is going to happen between investor and investor. There will be no bond issuer. Okay, so Reliance can sell this out to some other company, some other investor. Okay, and that transaction is called as secondary market transaction. Okay, so kindly read till here and confirm back to me, are we good to go till this entire steps that we have just now completed? Are we good to go? Okay, perfect. Now moving towards some other variations of bonds. Okay, so previously we saw types of bond on the basis of the issuer. Now we're going to talk about how exactly different bonds. So in today's presentation, we have only covered 3 different types of bond. One is a fixed rated bond, second is floating rated bond, and third is zero coupon. Now the fixed rated bond. Now we have already seen an example of fixed rated bond where you know exactly how much amount of coupon or interest you're going to get. Okay, so you have given $1,000 right now, which is a principal amount. Okay, and every year or every half yearly you will be getting $25. That is basically your coupon, and finally you're going to get principal plus coupon. Now this is called fixed rated bond because you know for sure it's going to be $25. It's going to be $25 for sure. That is why it is called as fixed rated bond. That is why it is called as fixed rated bond. Now one more example of this would be a zero coupon bond. Now zero coupon means you're getting coupon but it is zero. You're getting coupon but it is zero. Now look at this example. Suppose if I issue a bond right now, okay, today, which is time 0. Okay, this bond is for 4 years. Okay, now it's a zero coupon bond. Okay, then what is going to be the basic structure? Today, suppose I have been asked to pay $80. Okay, this is the price of the bond which I have to pay right now. I will get nothing in between. That means I will get 0, 0, 0. That is why it is called a zero coupon. And in the end, I'll be getting say $100. Now, do you guys realize I have invested $80 and I'm getting $20 extra in the end? That is nothing but my interest, which is paid at the end instead of being paid in between. That is why it is called a zero coupon bond. Okay, so all the interest is been paid at the end. That interest is basically the $20. That is the interest part or the coupon part, and $80 is basically the principal part. Okay, so this is nothing but your zero coupon bond. From the name you can realize it properly. Okay, now going towards the third section, which was basically floating rated bond. Now please be very careful over here. Now in a floating rated bond, you're not sure what is the coupon that you're going to get. I'll explain you how. Suppose today is time 0 and you have purchased a 4-year floating rated bond. Floating rated bond. Okay, now what is happening in this case? Suppose you're paying $1,000 as a price right now. Okay, and in this floating rated bond, let us assume that there is a market rate. Okay, now let me take an example of LIBOR. People who are working in the industry must have heard about this. So LIBOR is basically London Interbank Offer Rate. London Interbank Offer Rate. Okay, now what is this? This is basically every day the British Bankers Association releases the rate for 1 year, 2 years, 6 months, 9 months, every single day. Suppose if today we are sitting on time 0, and if today the 1 year rate, that means from here to here, the rate is say 7%, and this floating rated bond was based on LIBOR, that means whatever is the LIBOR we'll get. Okay, that is why it is not fixed rated. So you will get 7% of $1,000. How much that should be? 7% of $1,000. Is it going to be 70? So $70 you will get over here. As you reach on time 1, on that day also there will be LIBOR decided. Suppose the LIBOR for 1 year is 9% on time 1. On time 1, okay. Then on time 2 you're going to get $90 coupon. Okay, and as you reach time 2, there will be rate available for next 1 year. As you move ahead in time, you come to know what is the amount that you're going to get. Suppose the rate is 5%, then 1,000 ka 5% is basically your $50. And as you reach time 3, you realize, okay, the last rate, basically the 3rd year se leke 4th year ka rate is, say for example, 8%. Then on this day, on time 4, you're going to get $1,000, which is the principal amount, plus 80. This is how your floating rated bond actually works. Right now, I have taken an example of LIBOR. It can be LIBOR plus some percentage, it can be LIBOR minus some percentage, it can be some other rate also. But for my example, I have taken only LIBOR. Are you guys clear on the floating rated bond? Are you guys clear on the floating rated bond? Kindly confirm on chat. What about others? Money? No, this is not compounded. This is not compounded. We have taken a very simple example of an annual bond. We have taken a very simple example of an annual bond where the rate of interest is basically your LIBOR. It can be MIBOR also, which is Mumbai Interbank Offer Rate. It can be SIBOR also, Singapore Interbank Offer Rate. Depending upon what is a reference rate, you will be paid. Okay, so moving towards the next section. So we have completed the major part. Okay, we have talked about the fixed rated bond, we have talked about the floating rated bond, and we have talked about the zero coupon bond. Now one more important aspect which you can be asked in the interviews also is what exactly is the yield of a bond. What exactly is the yield of a bond? I'll give you a very, very simple example and you will understand how the yield is moving when the price of the asset is moving. Okay, now yield is nothing but how much interest you are going to earn, how much percentage income you are going to earn. Okay, now let us take an example. Suppose there was a bond which was giving a coupon of $10 every year. Okay, so can you guys see on the screen, can you guys see I've taken $10. That $10 is basically coupon. Okay. Suppose the price of that bond is basically 100. Now, do you guys realize what exactly is happening? You're paying $100 to get an income of $10 as a coupon, right? So that is nothing but an interest, or basically the income that you have generated in percentage is called as yield. That is basically 10 divided by 100, that is 10%. 10 divided by 100, that is 10%. Now, if I tell you tomorrow, if there is, suppose for the same bond, if there is some bad news that is coming, the price of the bond will go down because nobody wants to purchase that bond now, because there is some bad news that is coming up from that bond. Where as the price goes down, now suppose the price is $90. Do you realize to get the same $10 income, now today you have to pay only $90. That means your income percentage will increase, because now you're looking at 10 divided by 90. That is nothing but 11.11%. That means your yield increased because you're getting the same level of income of $10 by paying now $90 instead of $100. Okay, this is a second scenario. So whenever your price is decreasing, your yield is going up. Whenever your price is decreasing, your yield is going up. Okay, now let us look at the third scenario. Okay, if suppose the price is 110, if suppose the price is 110, okay, that means suppose there is a good news for the bond, so price has gone up. Now for the same $10 income, you have to pay 110. That is extra that you have to pay, right, instead of $100. Now what is happening? The yield is going down, because 10 divided by 110, that is 9.09%. That means when the price is going up, the yield is going down. This is called as inverse relationship, because if one set is going up, the other set is coming down. That is inverse relationship. Okay, so this is a very simple example of yield. Okay, yield is nothing but the actual income that you're going to generate in terms of percentage. Okay, this is the yield structure. Let us look at the final, which is basically advantage and disadvantage of a bond. If you are entering into a corporate bond, obviously the advantage is that you get to earn interest for that amount that you have invested, that is coupon amount. Okay, if you hold the bond till the maturity, you will get the principal amount back. Okay, you'll get the principal amount back. And finally, if the bond price increase in the value, okay, you can sell the bond to somebody else. Suppose I purchased the bond for $102 and today the bond price in the market is 115. I can sell it to somebody and get the difference, which is $13 in my pocket. Okay, so there can be capital appreciation also. Capital appreciation means the price of the asset has increased and you can sell it at a higher price. Okay, that is basically the advantage of a bond. Now some broad disadvantage. Okay, now generally bonds give you lower return than stock. Why? Because stocks are much more riskier. If you are holding a stock of the company, that means you are holding the ownership of the company and you're going to get money at the end. Okay, that means your riskiness is very high. That means your rate of interest will be very high. So comparing bond with your stock, bond is going to give you lower return as compared to stock. Okay, one of the bigger risks that you face when you are investing in a bond is basically the companies might default on payment. That means Kingfisher Airlines had taken money from the market of with 10,000 crore rupees, and once the companies become bankrupt, they are not in a position to pay you back. That can be the situation with you also. That is a big risk that you face. This is called as credit risk of the bond. Credit risk of the bond. Okay, next part, bond yield can fall. If suppose the price of the bond goes up, obviously you're not looking out to sell the bond, then the yield or the income that you're looking at can also reduce, like we talked in the previous slide. Okay, so we've talked about the yield of the bond. We have also talked about some of the advantage, some of the disadvantage in the bond. Obviously we have not got into the detailed structuring of the bond. That means how exact, there can be callable bond, there can be puttable bond. We have not got into that. Okay, there are different structures of bond also. There can be mortgage bond, there can be collateral bonds. We have not got into that. So we'll be talking about that in future sessions. But till now, today, we have tried to cover the advantage and disadvantage. Any queries till now? And also people who have understood the concept, kindly confirm good to go. Perfect, perfect. Thank you for the confirmation. So this is where we are closing today's session. Now, people who wish to join this batch, because we have started out with the May 2021 batch, and we are going to be continuing till April, obviously. So this batch includes sessions on. So currently we have only opened up for online batch, which is online session. So there is an online session available with us. We'll be also be giving you recorded session backup. There'll be self-study notes. There'll be question banks and mock papers being provided to you for your preparation for your FRM level 1. We separately also give video lectures made available to the students. Okay, so in Bombay we also conduct classroom sessions for FRM and CFA. Okay, but currently, since because of the COVID situation, the session is not doing the market situation is not open, so we'll not be opening up for that. But we have started out with the online batch, so you can look at that aspect also. And the video package is also available with us. In case of any queries, I'm there. I'm opened up. You can ask the query directly to me. And people who wish to join the batch can directly WhatsApp on this number, which is available on the screen, and they will help you out with the further process. Any queries, any quiz question, please you can feel free to ask.